Good morning, everybody. Welcome to the A.R.D. Consultancy first webinar of the new season. I'm Andrew Dawkins, and
I'm Rachel Blackholm.
And thank you again for joining us. Hopefully, you're going to get one or two bits of information out of today's events, which will be quite useful. And we'd love to have your feedback and questions. We'll just say at the beginning, if you have any questions, please could you enter them via your computer as we go along, rather than save them to the end. Rachel, what are we going to cover today?
So the agenda today, we'll cover what's happening at A.R.D. I'll run through a brief update as to the changes we've made and how we're working. Moving on to how we make money for our clients. So I'll then hand over to Andrew and he'll discuss how we design investment solutions and provide a bit of a breakdown to the portfolio's performance. Moving on to current market conditions, Andrew will then explain his take on what's going on in the world of investments and how the impact of recent events have affected them. Then the property fund suspension. As many of you will already be aware, the property fund used in our portfolios has been suspended. So I'll explain exactly what that means. And then finally, onto the outlook. I'll hand back over to Andrew to round off this webinar and then cover any questions and answers. So as Andrew mentioned, if you scroll to the bottom of the web page, you can submit your questions there. So enter them as we go along and we'll try and get through as many of them as we can.
Thank you very much, Rachel. Well, I hope everybody's fit and well and their family's also doing well. That's the main thing, I think, at the moment. What we're going to cover then, first of all, we're going to be saying, well, what's actually happening at A.R.D. and the offices, Rachel?
So first and foremost, we are open to assist our clients, although we've had to make a number of changes with lockdown. So Andrew and I are based in the Falkirk office and our other advisors, David and Gordon, are working from home just to try and provide you with the best service we can. At the moment, we obviously can't offer any face-to-face clients, so we've had to conduct a number of the reviews over the telephone. We're also trying to send out some more client newsletters on a more frequent basis than the usual monthly ones, just to keep you all updated and keep that communication open. We're going to be using this time as well to look into other ways of working and making the most of the technology, given that this situation is likely to continue for some time. I'm sure many of you are probably using apps and websites such as Zoom for your work at the moment. So that's something we're going to be looking into to see if we can, although we can't do face-to-face, almost see each other and try and keep that relationship up as best we can. Since lockdown began, we've had a number of things that we've had to deal with. We've had tax year end, so we've been able to assist those clients looking to make use of the annual ISA allowances or pension allowances. We've also been able to help those clients looking to put away some money that they might have had sitting on deposit and try and benefit from the current market conditions. And also, on the other side of things, we've been able to help facilitate withdrawals from people's investments or pensions for those that have been affected by the virus. So as we see it, we're still able to provide you with the usual ongoing service as best we can, albeit remotely.
Lovely. That's right. Well, I think we have to say we are missing seeing a lot of our clients, well, all of our clients actually, and it is quite good that we're getting one or two people coming in waving at us from outside of the streets and looking in, which is a little bit upsetting when we're least expecting it, but lovely to have that contact as well. So we'll try and maintain that going forward. So the next section is how we make money for our clients. And what we thought here it'd be quite good to go back to the basics to see, well, actually, what do we do to try and make a difference to people's finances? So we're concentrating this morning really on investments. So this is where we sort of feel that we are able to add a considerable value. What we need to be aware of initially, though, is if somebody's looking to actually make the money grow harder than that on deposit, we have to take risk. So there's a risk with everything. We used to have a number of years ago a no-risk investment, which was the NS&I, the National Savings inflation-linked bonds, which meant that your money was safe because it's backed by the government, and also the money kept pace with inflation. That was withdrawn from the market many years ago, and since then there really hasn't been anything that's guaranteed to keep pace with inflation. So to be able to do that, what we need to do is to take a risk. Now, for most clients that we deal with, taking a risk is no issue at all, because they were looking to invest for the medium to the long term. So at least 5 years. Many of our clients don't have a set use for the money, perhaps to sort of spend in retirement, for example, but don't say, well, look, I want my money to last for the next 15 years, after which I don't need any money. So most clients will be saying, well, I want my money to work for my life, and therefore we're able to take a longer term view. Now, taking a longer term view means that we can beat inflation, which is the big enemy, over that time period. But during the short term, we have to accept that there will be times when the investment falls in value. Now, if we move on to the next slide, this one here shows our investment portfolios. Not everybody will be invested within our portfolios. We have some specialist funds, and we have funds that are not available within the portfolio. However, a lot of clients will be familiar with the 5 investment styles that we currently use. So if we look on the left-hand side of the chart, this here, the 4 bar chart areas, first of all, identify the defensive portfolio. And to show that the time period of the last 1 year, the last 3 years, 5 years, and finally 10 years. Now, the defensive portfolio has significantly less equity exposure than any of the other 4 portfolios we've run. So defensive at the moment has around about 20% share exposure. And we'll see then that over the last year, the portfolio, if we invested exactly a year ago, is down by around about 0.5%. So 0.5% less money in the portfolio than we had a year ago. Over 3 years, it's up almost 8%. Over 5 years, by 20%. And over 10 years, 63%. A lot of clients will perhaps start in this portfolio that have been used to perhaps the way cash accounts work. So they're coming in and saying, well, I can afford to take a risk. In other words, the value will fall. I'll accept that. But I'm wanting a little bit more than the bank will currently give me. So this is a good starting point for many clients. Moving along then, the next set of bar charts show our cautious portfolio. And what happens here is that we use a lot of the same investment funds, but here we have up to 35% invested in shares, because shares is the asset class that generally delivers the good long-term returns. It's also the asset class that perhaps will come down furthest when market conditions deteriorate. Nevertheless, the cautious account has delivered over the last 1 year around about 2% loss. Over the 3 years, we're talking about a 9% return. 5 years, 24% growth. And over 10 years, you would have seen a 79% return on your investment. The middle charts then are for our balanced portfolio. This is one of our largest portfolios we run. And here we have 57% of the portfolio currently invested in shares. And here we can see the returns over a year. You would be down around about 3.5%. Over 3 years, you would have made around about 11% return. 5 years of 32% return. And over 10 years, you would have more than doubled your money. So it's just showing a trend here that the higher the equity component, the more we make over the medium to longer term. The final 2 bar charts then illustrate the capital growth account, which has 76% equity exposure currently. And finally, the aggressive portfolio, which has at the moment 88% share exposure. All the portfolios have worked exactly the way we would envisage them to work over the last few months. So the cautious and the defensive portfolios fell by less than the balanced capital growth and aggressive portfolios. And the current investment upturn means that the portfolios are now increasing in value, and the aggressive will increase the highest at the moment. So that's really how we make money for our clients, is by taking the longer term approach, and that allows us then to make good profits. Now, turning to our investment style, What we do here is that I've, believe it or not, been in the industry for 36 years now. Incredible. I started when I was 1, so that's a great benefit of early starts. And Rachel's been in the business how many years, Rachel?
Believe it or not, 14 years.
Well, yeah, I think everybody can believe that. So, and what we do is we have regular meetings. I meet with Rachel literally every day, and we look at the investments that are available for our clients to use throughout the world, really, which are regulated here in the UK, but we can look at investments worldwide. And what we tend to do is draw on those investments which deliver added value to our clients. Now, what we mean by that is that we could quite easily just adopt a computer program and try and mirror the various indices that we're trying to follow. So we've got property exposure, we can have a property index, we have exposure to shares in the UK and overseas, we have exposure to fixed interest, which is really debt, so company debt, and as well as that, government debt. And we can just use an index tracker to follow these. But what we want to try and do is beat the index, deliver superior returns so that when markets go up, we will also get growth, but perhaps at a bigger margin. And when markets come down, importantly, we want to try and cushion that downside. If we look at, this is the top 10 holdings currently for one of our portfolios. Now, Rachel, you've got something interesting here to note.
Yeah, so this is just a snapshot of the top 10 holdings within one of the funds in these portfolios. On the left-hand side shows the 2020, currently how the portfolio looks, and on the right-hand side, 2019. So this is exactly this time last year. I think the main thing to take from this is there's not really much of a change as to how it looks now compared to last year. And this shows us that the fund manager doesn't really see and need to be making any big changes to the holdings as a result of the market volatility. They believe that these companies are quality, and I think the fact that you're seeing not great changes in them regularly shows that they are of that standard, and that gives us the confidence to sort of stick with it, that after all this passes, we're hoping that they're going to be solid companies that will still provide the growth that we're looking for. This is just of one of the funds in the portfolio, but the rest of them all really adopt the same approach.
So it's investing for the long term again, so that the fund managers are not engaging in shorting, because we don't think ethically we don't like that. So that's where somebody buys a share in the morning and perhaps sells it on in the afternoon without then perhaps hopefully take a profit, but they can even make a loss. But the fund managers we use currently, they adopt a more long-term view where they want to work with the companies over a number of years and engage with them. So this helps things that sort of create that good working relationship, and they're a lot more trusted then by the companies that they invest in and the assets that are similarly bought. So it just shows that there hasn't been a tremendous difference between now and what there was a year ago. That's in our balanced portfolio. If we then look at one of the big components of our balanced portfolio is our equity fund, and currently we have 2 equity funds that we recommend within the portfolio. Lion Trust is by far the biggest of the percentage holdings, and we use their special situations fund. Now, what we mean by adding value, remember we were talking about that a few minutes ago, is on the charts here, we can see the Lion Trust fund against that offered by their competitors or their peers. And what's happened again is that they're adding value to us, and therefore your good selves, by delivering superior returns. So over the last year, yes, the account has fallen. So we're around about 10% down, but the industry average for the same level of risk in this sphere is down 16.5%. So we've fallen, but we haven't fallen as far as the rest. When we look then at the 2, 3, 4, 5, and 10-year periods, again, we're making money against the competition. We're making even more money. So at 3 years, we're up almost 7%. At 5 years, we're up 32%. And over 10 years, then we're up almost twice as in terms of investment growth. So a really good fund that we've stuck with for a good number of years, because again, we want to build relationships with our fund managers over a long period. So Rachel and I have regular conversations with all the funds that we invest in. Occasionally we'll meet up with them. They'll come to our offices here in Falkirk or Glasgow, or we'll go and see them wherever they're based, because we want to understand occasionally the funds will perhaps underperform or underdeliver. There might be a reason for that. Yes, nobody's perfect, even Rachel. And what happens is occasionally they get it wrong. And as long as they're open with us and say, well, we judged this incorrectly, we'll say, well, that's okay. We'll continue with you, as long as they actually tell us why. So that's the position for how we select our investments and our style. And now we'll move on to
the current market conditions. So what's your take on the world of investments, and how have all the recent events affected them?
Yes, well, that's a very good question, Rachel. Glad you asked me that. So it's almost as though it's scripted. Well, if we look at the next slide, this will probably illustrate where we are. Thank you very much. And the start of the year, everybody, just about everybody, I haven't found anybody that was negative. Just about every industry expert was saying that 2020 was going to be a fantastic year for making money in virtually every sector. The only sector they were a bit nervous about was government debt. Now, so far, yes, it has been an outstanding time period, but for all the wrong reasons, and the only asset class that's really shining is the government debt sector. So it just shows how these experts get it wrong as many times as they get it right. So we started off January, and the beginning of February was super. Really, really good investment returns, and round about that time we got to the 8th of February, that showed so the highest return we've seen from the investments to date. The graph here illustrates again our balance, so our middle of the road investment portfolio, which is our biggest portfolio we run. It shows the performance over the last 5 years against the industry average. So we're comparing like with like. And what we can see is that we get upward growth. So on the right hand side, we finish the time period with more money than we started with 5 years ago. However, we then got to the middle of February, and suddenly the world woke up to the fact that, well, the coronavirus wasn't just going to cause difficulties in China, but indeed worldwide. So it was just one Monday, 6 weeks ago, the market fell to pieces. A huge one-day fall. And then a week later, we got a double whammy, because then OPEC fell out with Russia, or vice versa, and decided that they would increase the supply of oil, which then had devastating effects on the oil market and the economies generally, because economies are so heavily dependent on oil and the taxes that oil revenue bring in. So that was a double whammy. And then a week later, what seemed to happen on the Monday, Donald Trump announced that he was going to ban people traveling, non-US citizens, in and out of the US. So this was the lockdown starting in a big way. So we had lots and lots of falls. Within 3 weeks, the account had fallen to its lowest point since 1987. So the falls were bigger than 2008, and were only eclipsed by those in 1987. Since then, the good thing is that the world banks, the governments throughout the world all took action to pump liquidity into the market. Liquidity means there was just a lot of cash available, so that if investment people wanted to move out of shares, they could buy currencies. So the liquidity was the big issue, because of the fact if investment managers couldn't move out of markets easily, that would cause a further stampede towards the exit door. That didn't happen, because the banks around the world took a decision to pump a lot of money into the economy. They also did things like the furlough scheme, made money available for people so they could provide some sort of safety net, because they realized that a lot of people are going to be adversely affected by this. That's continuing to be the case at the moment. But because of that action, the concerted efforts throughout the world, the markets have taken confidence and have moved forward. So they're no longer feared that we're not going to be able to sell our share portfolio, we're not going to be able to repay loans and debt given to companies. They're now moving forward with a bit more certainty. Now, will this continue, or will we see another decline? It all depends actually on when there's an end to the virus. So that needs to be a vaccine in place and everybody cured, and the pandemic ends. because otherwise you're fearful that, yes, there could be a second or a third wave of illness, which then forced the market back into retreat. Many of the clever people, remember, are just as daft as you and I, are saying that the worst of the conditions are behind us, and that we will now see growth, although it will be sort of tentative. Now, from our position, though, when we're looking at the investments, these short-term movements are actually quite good for us, because they give us the chance for the investment funds to buy assets that would otherwise have been too expensive. So whether that's property, whether it's government borrowing, company borrowing, or shares in companies. So they either increase holdings in those shares and those assets that they believe are good, or they take the opportunity to actually then buy new assets that would have otherwise been too expensive. So when we get this volatility, it actually is very good for us. I know a lot of people laugh at that, but it is, because it drives future years' profits. So we can see that from 87, we saw that in 99, 2000, in 87, and 2008, and also when we got to October 2018, which was the last big significant movement when, again, Donald Trump, our friend, we love him, we love Boris. Anything that creates volatility is good for us. So Donald started the trade wars specifically with China, again, one Monday morning. So obviously he didn't have a very good weekend. Gets up on a Monday morning, tweets that he's going to put tariffs, restrictions on Chinese goods, steel in particular, and the market reacted very, very badly, because that was the start really of trade wars, when what we want is more free trade rather than putting restrictions on. But then within a short space of time, the markets recover considerably, and they recover at a faster rate and a higher rate than they would without that being influenced. So it is a good point. As long as we buy quality, so as long as the funds that we're invested in are good quality funds, then we're getting a good deal. Fund managers go out and may make silly decisions. So we've seen some silly decisions being taken recently. And then you go, well, we won't have anything to do with those funds or investment managers. We don't want them. We want to be able to say, yes, that's a quality company. It has little debt. That's a quality asset. It's quality lending. It's quality borrowing. It's all about quality, because over a time period, that's what shines through. Rachel, have I missed anything?
No, I don't believe so. That was quite in-depth. I think you have a sip of tea after that.
Sip of tea, thank you very much. That's always good, because I think I should hand over to you now for what's happening in the world of property.
Yes, so many of you will have read in the newsletters and received letters from the investment providers. The property fund that we hold in the portfolios is the Legal and General UK Property Feeder Fund. This has been affected along with many others in the market. So many of the property funds out there at the moment have suspended trading. So the reason for it is really quite straightforward. Because of lockdown, the surveyors are physically unable to make site visits and provide accurate valuations. So to protect investors, these investment managers have taken a decision to suspend the fund, which means that no money in, no money out. And that's just going to sit this way until lockdown eases. After that, when people can start going out and about and they can get out, visit these premises that they own within the funds and put up an accurate valuation on it, then the funds can reopen. It really is as simple as that. We've had some calls from people asking if it meant that it was completely closed and they had lost their money, but that's not the case. It's just sitting still at the moment. So like I say, no money in, no money out, but over time it will reopen and people can access their investments, top them up as they usually would.
Yeah.
Anything you want to add on that one?
Well, I was just thinking, if you're investing in property at the moment, commercial property that is, what's the exposure to the retail sector? Because you see the high street, see the devastating effect that this is potentially going to have on that sector. So do we know what the percentage holding allocation to retail property is?
Yeah, so that is, again, like we said, we have a lot of communication with the fund managers. And what we like about this fund in particular is it has a very low exposure to UK high street. That is currently at 4%. So only 4% of the monies invested in this fund are in UK high street outlets. offices, shops, those sorts of things. So we like this one because it has a much higher exposure to a lot of other areas in the high streets minimal.
That's good. That's good. I believe as well, Rachel, it also has quite a holding of cash, so that if people are wanting to take the money out when the fund reopens, then they have sufficient assets to cover that.
Yes, it is. It's what they call quite liquid at the moment. So they believe they hold enough on cash to allow people to access money if they want. It is not fully tied up in property, meaning that they can't get at it.
No, that's good. Well, it's quite interesting. I had a chat yesterday with the Lion Trust guys. That seem to be the only fund we're talking about here, but we use many other investment funds. It's just that we've got a particularly close relationship with them. We let into a number of their secrets. And one of the things they were saying is that they're seeing greater money coming into them than people taking money out. So they're still seeing net inflows of money, even at the height of things a month ago. They were actually seeing a great deal of money being invested because people saw this as a long-term buy opportunity. The other thing this gives them is that they've got round about, for that fund, 12% of their assets are currently in cash, but they can't rush and buy assets because they want to be fairly careful about that. They will take the time, even though they could be saying, well, there's a good bargain to be had here. That, again, viewing it as a long-term transaction, so not rushing into that. So what does that leave us with, Rachel?
Your outlook. So it's covered quite a bit in detail there, but as you say, we look to invest for the longer term. What's your view on things?
Well, we still got in the background the B word, the Brexit word, which has been off the news for the last few months, and that, as far as we're concerned, and as we said right at the beginning when the referendum result came out, is very, very good, very encouraging for what we do for making money for clients, because again, it creates that volatility. So Brexit will be happening presumably next year, and that will give us positive returns again over the medium to longer term. Short term, yes, we're going to still see a rocky road for the next wee while until the vaccine is there, this horrible virus is actually being killed off. Until then, there'll still be that uncertainty. But in the world of investments, there are always uncertainties and things that come along that nobody was expecting. And the way we position is make sure that, again, we've got those quality assets, because quality will shine through. So the outlook is very, very favourable. And for everybody, we just hope they remain safe and healthy. Now.
Okay, so if you just bear with us a wee moment, we will mute the call and have a look through the questions, see if there's anything that we can answer in the meantime, and we'll be back to you shortly. Hi, right, we've got a number of questions in. So, question here from Ian: should I review my attitude to risk?
That's a very good question, Ian. Thank you very much for asking that, and good to have you with us. Yeah, it's one of those things that we review at every review meeting we start, just to sort of see if the current attitude to risk has changed at all since the last time we met. At the moment, we haven't really noticed any significant changes in style. So if you were previously at a level of risk, say a capital growth level, then we would recommend that you remain at the capital growth level, because your long-term objectives haven't changed. However, if there's been a change in personal circumstances, then yes, it's always a good idea to review. So just at the moment, we haven't really made any changes to attitude to risk, although there have been if there's an occasion whereby somebody says, look, I'm now retired, or I'm a major expenditure, or a significant difference to my personal circumstances, then yes, we should look to review that and adjust it. And we can do that at any time. So if anybody out there is looking to make a change, either to take more risk or less risk, then it's a good idea to get in touch with us. Thank you very much for that question.
Okay, another question here from Liz. Do you believe that markets have reached rock bottom yet?
Hi Les, good to see you with us as well. Probably the answer to that one is yes, because at the beginning of this, the coronavirus 2020 became worldwide, then markets overreacted, every market, every particular sector, because what they do is they take the very worst scenario. So they say, right, well, okay, let's assume this wipes a lot of the population out. Let's assume economies are ruined for the next so many months, if not years, and we're going to assume that scenario. As things pan out, it was just very similar to the Brexit scenario. So many people thought that was the end of the world when we voted to leave, and yet things since then have improved considerably. So I think we have seen the worst of it, and although if the pandemic catches on again after lockdown eases, then there could be other significant falls to be had, but not as far as we've fallen previously. So thank you very much for that, Les.
Okay, one here from Derek. With the property fund suspended, if you are a regular monthly investor, does the proportion of monthly investment that would normally go into the property fund go into the other areas of the funds?
Yeah, super. Hi, Derek. Nice to have you on dry land. I think Rachel's best place to answer this question.
Yeah, so as I mentioned, there's no money in or out in this fund in the meantime. So we have redirected any of the regular monthly contributions to a gilt fund. So the government borrowing, as Andrew mentioned previously, that seems to be one of the more solid funds at the moment. So what the money will be going into there each month, and what we'll do when the fund reopens is look to rebalance that, move the additional money that was going into the gilt fund back into property, and then redirect your monthly contributions back to property as normal when things resume. And then let's see, probably time for one more. Tribute. So in terms of mortgages, what impact does the change in lending have overall?
That's a very good question, Tribute, and good to have you with us. Well, the mortgage market, if you're looking for a mortgage just at the moment, if it's to buy a property, then it's particularly difficult because, as we were saying before, the surveyors are not actually physically able to visit properties, so that makes property sales difficult to transact. In terms of somebody looking to remortgage, so they've perhaps come to the end of the current tie-in period with the lender and they're able to renegotiate that rate or go elsewhere, there's a couple of things here. One, rates are at the lowest we've ever seen them. So I know in 2010, people said rates would never get any lower than they were then, and since then they've constantly been falling. So there are some really good remortgage rates to be had at the moment. One of the challenges, though, is that anybody that's been affected financially by the lockdown, the current situation, is perhaps having to answer more questions relating to the current income and expenditure. So, for example, if they've been put on reduced hours or furloughed or any of the other restrictions, and it means their income has fallen, the lenders are asking more questions concerning that. By and large, though, the mortgage market is fairly strong. Lending is significantly down just because of the fact that physically it's impossible for people to get solicitors to work or the removal companies to come in or the other bits and pieces which rely on human involvement. So super question, Tribute. Anybody that has a specific question that hasn't been answered, shall we try and answer those?
There are a number of other questions. Conscious of time at the moment,
yeah.
So I think if we wrap it up and we will reach out to everybody else. So thank you so much for sending in the questions. We'll reach out to you all individually and answer those.
Yes, that's good. Anything you want to end them with, boss?
Thank you for sticking with us and bearing with us for our first webinar. Any feedback would be greatly appreciated. This is something that we're looking to do on a regular basis if you all are interested in it. So we would love to hear what you think, what you'd like to hear about, any topics at all. What do you want from us? And we will try our best to accommodate.
That's great. It's been a live event this morning. We're grateful that Posty hasn't interrupted us, or the clients haven't been phoning up, which is good because we wouldn't have been here to answer the phone or the door. And what we're going to do is we're going to send you a copy, should you want it, of the current presentation. So you can send that on to anybody that you know might be interested in our ramblings. So on behalf of Rachel and myself, thank you very much for listening today. It's been a pleasure having you with us. And thank you so much as well for getting dressed, so many of you. There's always the upset. There's always one or two people that, but anyway, right, lovely to
leave it there. Thank you.
Yes, thank you. So what we've now done is put together a second segment whereby we're going to answer the questions that we didn't have time to go through earlier. Rachel, what's the first question we have?
Yes, so question in from Graham. Approximately what percentage of investments are related to FTSE 100 or FTSE 250?
Yeah, thank you very much for that question, Graham. Just at the moment, we have around about 25% or a quarter of the holdings are FTSE 100 companies, and then we have 14% in the FTSE 250 space. Hope that answers your question, Graham.
And that relates to the balanced portfolio.
The balanced portfolio, yes, I think that's the one we're concentrating on in this presentation, but the other portfolios will have different makeup depending on the equity holding.
And then question in from Vary. So relating to the balanced portfolio top 10 holdings slide, she's noted that the icons have moved around year to year. Does that mean that BP having moved further down means less investment in that company? So here's this slide here. And yes, and well, in short answer, yes.
I think you can see from this that BP has moved from last year. It was in third position in terms of its allocation, and it's now in sixth position. And similarly, Shell has also moved down the ranking table. So over the last year, we've seen that the fund manager has reduced the exposure to the oil sector. And I think it's sort of a good move given what's happened to the oil industry just at the moment. So they're still in the top 10 significant holdings, but their allocation is reducing.
Question from Jackie. What are your views on property values post-lockdown? I can see a lot of businesses moving their workforce to working from home where possible.
That's a good question, Jackie. Thank you very much for that. And I also should have said thank you very much, Vary, for the last question, because she'll get upset if I don't give her another name call. I think the answer to the question regarding the property is an interesting one because of the fact that the property market has changed so much over the last 20 years or so. When I first started in 1826, we had a lot of allocation within the property funds towards the high street hotels and the inner city sort of areas, and especially down in London, there was a high concentration of assets owned in London. Whereas when we look at the property construction at the moment, then it's spread more equally around the UK. So we've moved out of central London. We also have less exposure to the likes of the high street. We have more now in out of town shopping, but we also have more in the likes of distribution and warehousing as more and more companies use warehousing facilities to get products to consumers in a quick fashion. That's changed over the years. Well, I think it'd be interesting to see what the effect of the lockdown and people working from home is going to be. So yes, there could be a switch away from larger offices into home working, which then drives people to sort of have less need for the big office spaces. On the other hand, they may find that actually people like working with other people, and the home office, the sector there remains very similar to what it is at the moment. But it's an interesting one, and we'll keep tuned. And as these things change, that's where our financial advice changes as well. So we won't be dogmatic. We'll keep an open view, and if we see that property is an area that perhaps we should move away from, then we won't be shy in doing that. Although the fact remains, we're a very small land area, and we've got the best part of 70 million people living in it now, and that there's always going to be a demand for property of one form or another. So hence the reason why we probably will keep a foot in the property sector. So no great answer, I'm afraid, on that one for you, Jackie, definitively, but our guess is probably as good as anybody else's guess, I'm reckoning. What do you think, Rachel?
Yeah, it's like you say, it's always something that's changing, so we'll change along with it. And I think from what you've said there, it follows on quite nicely to a question in from Tom, who said if only 4% of the property fund is invested in the UK high street, what is the balance? So you'll see here, we've taken a snapshot of the fund that we use, the Legal and General UK Property Feeder, and how that's broken down at the moment. So currently there's around 35% of the fund invested in industrial units, approximately 24% in regional office space, 15% categorised as other, another 15% in out-of-town retail, 4% in office space in London, 4% in UK retail high street, as we mentioned, and 3% in leisure. So it's a good split there, and as Andrew said, the higher allocations are to more those larger premises that we don't think will be affected quite so much as the high street. And question in from Michael, should I postpone my retirement until next year? Andrew.
Michael, Mr. Moneybags. Well, I think when we're looking at plans for retirement, then the current drop in values shouldn't actually significantly change plans because of the fact that we're looking at investment returns over the longer period. And as you've been a client of ours for a number of years, you've made good profits. As a lot of people will be using their investments within retirement, these need to continue to take an element of risk so that they can generate the returns and the income needed to actually meet your investment goals, which is perhaps to be able to give up work or even to sort of do things like change the car more frequently or spend an extra week or two on holiday each year. So when we look at the longer term picture, which is really what it's all boiling down to under this presentation, then it shouldn't alter anybody's plans too dramatically. People would be affected if they had a set amount to be funded for within a short period of time, because those goals could be cast asunder because of what's happened recently. But for the long-term aspect, which is I'm going to be retired and I'm going to be retired for a good number of years, then actually the values at the moment shouldn't prevent anybody from doing that. The key always is to have individual financial advice, and we'll be delighted to chat with you at our next review meeting, Michael, just to see what the best way of proceeding is. But I think generally, no, people's views and attitudes and needs are very much the same, and it's all boiling down really to long-term investment performance for driving your ability to be able to maintain that. So no, I think we'll carry on.
Great. Next question in from Graham. How often do you update the investment data on the website and what time of the month? So I'll take this one if that's okay, Andrew.
Yeah.
This is an automated process, and it really does depend upon what policies you hold, what providers you're with, and how they link into the workings of the back office system which run the client websites. The majority are available daily using what they call real-time valuations. And that means that every time you log in, you should be able to get the most up-to-date valuation available. So if you log into the client website every day, you should see that valuation every single day and as it changes. If you don't log in for quite a period of time, the valuation will only then be updated from the next time you log in. So the bulk of the investments, when you see the chart, it honestly depends on how often you log in. You might see a bit of a straight line up or a straight line down, depending on how long it's been since you last viewed it. And then obviously if you've added money or taken any money out. But if you log in every day, you should see the exact progress of your investments.
No, that's good. Is there a difference as well between which machine you log in with? So I've noticed when I log in on my iPad, sometimes I can get a different value to when I log in using the computer.
Yes, that is correct. So that's one of the things about technology. Using the devices such as your apps on iPads and phones, they do tend to have these little gremlins, unfortunately. And what we have found is if you log in through a PC or a laptop using the web browser, they're a lot more accurate, and they're the ones that do filter through correctly every day. Seems like there can be a little bit of a delay or whatever's going on in technology when you do it on your iPad for some reason. Something we'll try and fix, but that's for the brains behind the operation.
Great, thank you for that question, Graham.
So Alan sent this actually just after we finished the webinar, and he said that he's logged in to listen to it and what you had to say about current financial conditions. Overall, I took from it that we are better than others and that there isn't going to be many changes in your current strategy. What he's asking is now a good time to invest a little bit extra or waiting until this epidemic is gone? What would you advise?
Well, I think you know the answer to this, Alan. It's never a bad time to invest, again, because we're investing for the longer term. Some people, though, have been a little bit scared by what's happened recently, and they're saying, well, I appreciate it could be a good time to invest, but I just want to keep some money back to see how things develop. Really, we wouldn't want to change somebody's view on that. So if somebody's happier just to keep the money on one side waiting, then that's fine. That's absolutely fine. No problem with that. Because overall, whether we invest now or we invest in a year's time or 2 years' time, when we keep the investments and when we look at them, the returns are going to be good no matter when we make that investment choice. But just at the moment, yes, we're probably getting a lot more people investing. It's a really good time for us in the office here because of the fact that this is when people look at what they've got and look at the returns they've had with us over the years and decide, well, actually now is the greatest time to probably be maximising the investment potential. But it all depends on people's ability to be able to sleep at night.
Excellent. Now, can't wait to hear your answer to this question from Colin. If we keep our funds with you, can we all get a fat rascal?
And the answer to that, Colin, is Rachel. Rachel, you're in charge of the budget. Well, I think that's a big it depends, Colin.
At the next 20th anniversary.
Yes, the next 20th anniversary, we shall give everybody a fat rascal, providing you're still with us. Colin, if that's what it takes to keep your business, of course, yes, we'll be delighted to get one of those for you.
So I think that rounds off all the questions that we had about the first webinar. So thank you once again. Thanks for your questions. Thanks for listening. And we've had so many lovely comments about it. I appreciate the feedback. Once again, if there's anything you want to hear about, then please let us know.
Yes, thank you very much. You've been a great audience.
Stay tuned.